wealth builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hello, welcome everyone. We have got a really exciting show today because we have a special guest. This is part of our Thought Leader series that we do every once in a while. And I am really excited to have this show in particular because I'm going to be chatting with an old friend of mine who has a great deal to share about the options industry as a whole and lots of really interesting things to share. And he's been part of the industry for, holy moly, Greg, I don't want to date you, but
it's been a while.
It's been a while, which enables him to bring a really rich history of conversation to everything we're talking about today. Please welcome Greg Stevens, Vice President of Options at Fidelity. How you doing, Greg?
Dan, I'm doing well. You set me up here. I mean, something interesting to say. I guess we'll have to determine whether or not that happens, as we go through the show. But doing well. Happy to be on. Good to chat with you. It has been a while, and a few years between now and when we last worked together, for sure.
Yes, it has, hasn't it? So tell our listeners a little bit about your background. Sure. And what you do over at Fidelity these days.
Yeah, well, Dan, as you mentioned, I've been around the industry for, quite some time. It's been close to 30 years at this point. Just a quick little background. I started off at Charles Schwab way back in the late 90s and made my way to Chicago working for the Chicago Board Options Exchange, and then on to Fidelity in various roles, from what we call a regional brokerage consultant, who helps support branch offices and active traders like the folks who will be listening, to this call, or traders just in general who are interested in learning more, everything from technical analysis to options to just investing in equities and fundamentals. So I had a good little stint, in that, and then I moved to the Boston area, where I currently am Vice President of Options Strategy at Fidelity. Working to drive the user experience for customers across our platform when it's related to options, from mobile all the way through to our active trader platforms, and hopefully providing, good tools, good information, good education, so that customers can achieve their overall goals. And, one interesting thing, Dan, that I didn't mention is that I was really brought into this world kicking and screaming back in my Charles Schwab days. Had a really good friend named Tony, who was like, let's just go, and it's back in the late 90s when we had, the .com really just started, web, started to come out, and the business was growing. More investors were being able to get involved, and they were looking to expand the options group. And I'm like, he's like, let's just go talk to him. And I'm like, no, I don't know that that's something I want to do. I enjoy options, but I mean, is that really where we want to go? And he's like, oh, just come, with me. And I'm like, fine, I'll go. And then, as they say, the rest is history, from options to futures to commodities to everything else in between. That's where it all started. My good friend Tony dragging me into just an informational session.
Wow. Serendipity, man. Serendipity.
Exactly.
So you've built a good part of your career focusing on the education aspect of option trading. So tell us a little bit about that. Why is option trader education so important to you?
Well, trading in general, does require, it's a bit different. There's fundamentals, there's, charts, there's a whole lot that goes into just determining, what stock, that you might be interested in. It's not only Microsoft. A lot of people like to invest, in things that they're already familiar with, whether they work at the company or they use the products. But particularly when it comes to options trading, it's not, if the stock goes up $1, how much do you make? $1, right? If it goes down $1, How much do you lose? Well, you lose $1. With options, well, it's delta, and you start throwing out delta, gamma, theta, vega, rho, investors start to, their eyes start to glass over a little bit, like, what are they talking about? So particularly when it comes to option trading, it's a good idea for investors to educate themselves first, to understand, what the products are, to understand, how, the options model, Black-Scholes, binomial, Cox-Ross-Rubinstein, there's variations on a theme here, right? But when it all comes down to it, it drives what, that underlying value of the option is. And so it's important to know how events, how just basic stock movement goes up. If you're, trading, if the option goes up, if the stock goes up $1, you make delta, maybe 50 cents, maybe 25 cents, a version of that. So it's good to understand why, and it's just not that, oh my gosh, what just happened to me? So education is key, understanding is key, and how you can, use this to improve your overall financial performance and accomplish your overall goals. So education for me has been one of those things. And Dan, you and I have been out on the circuit for many years, educating individual investors. There's a demand, there's a need for this, and that's why we try to do all we can at Fidelity, and I think the industry as a whole does a tremendous job at this.
Yeah, there's a lot of effort out there, just on many fronts that both of us have been a part of, you even outside of Fidelity, of course. So let's get a little specific here. So I know Fidelity offers a lot of education to their customers, and that's probably a pretty big responsibility. Why does Fidelity bear the expense and effort and everything that goes along with it? Why do they provide all this education for their customers?
So, I mean, I think there's many reasons, that we go into this, and I mentioned a few of them previously. It's important for educators to be invested, to know what they're trading and what the impact of an investment is, when the individual makes it. Am I looking to earn income? Am I looking, of more of a directional, longer term play? Am I looking to use leverage? We hear leverage a lot, when it comes to options. I may not be able to buy, Amazon when it was at, $3,000 or $2,000, right? But maybe I could buy one option, that gives me the participation of 100 shares for a fraction of the cost. But why is that? So education is key. I mean, Dan, we talked a little bit about, how long we've been in the industry. I mean, I remember when I started back in the late 90s, there was very little information available online. Charles Schwab, just not very long before that had really driven discount brokerage, where it made it available. I remember at, Schwab thinking that, oh my God, that's all it costs, $59.95, to buy 100 shares of, Microsoft. And I mean, look how far we've come, I mean, where we don't charge anything for equities, a small, a small, version of that, for options. But I mean, there's a lot that goes into it. And so education has played a key role. And especially in the late 90s, where, I mean, when you and I were at CBOE, we would go out and we would go to Omaha, Nebraska, for example, and we would be able to see 100, maybe 150, individuals at a time. And so the reach was good, but what about those folks in Fargo, North Dakota, or, Abilene, Texas? It is Abilene, right? Well, my geography is not so good at times, but how do we further, the reach of that? I remember there was one gentleman in Omaha that I probably seen 3 years in a row. And he was there. I seen him ask the same questions. And so we were talking, in that third year. I'm like, well, how are things going? He's like, well, I'm still learning and, he's still looking. And I'm like, well, have you placed your first trade? He's like, no. He goes, I'm still uncertain about what to do. He goes, this is my, and really this was his one opportunity to learn a little bit more. I mean, you can buy the books. I mean, there's a lot of good ones out there, yours included, of course. But, when, when we transitioned from the 90s into the 2000s, that information started to become more prevalent and started to become, more available. And I think as an industry, we've done a phenomenal job. And it's super important as investors have changed over the years, just from wanting some information to then wanting it in context, as to where they're at, getting out on these social sites, right? I mean, making sure that the right information is being disseminated, that, delta, the definition, or gamma theta vega rho. I mean, we're explaining those things, why options are valued for part of your investing portfolio. So education is very key. We see that, customers like to learn in context with what they're doing. They maybe don't want to go out and read, a full length book, but how do we get and disseminate that information so they're making good decisions, they're making informed, and education is a big component. And that's why we and the rest of the industry does a really good job. That includes exchanges, the OIC, which is an industry group, our counterparts, our competitors, at other firms really, really do a good job, of trying to get the right information out to our customers. So important, it's going to be important going forward, and we're looking forward to, engaging customers where they are and with what they need.
Yeah, man, there's a lot to unpack there. You brought up just like a lot of really interesting points. In particular, I guess, I don't know, I haven't really thought about it this way, or at least not in a while. Just the idea that back in the day, you used to call up your broker on the telephone and he or she was the person with
Yep.
all the information. And then we went into this discount brokerage, which led to being self-directed, which led to the need for these individuals who are trading for themselves to have all this information. Interesting.
Yeah, I mean, it came fast and quick, and and I think that overall, it's been really good, for access, for customers being able to reach their financial goals in a different way.
Mm-hmm. And then as time unfolded, we have this new way for, I guess they used to kind of call it democratized media.
Yep.
And now anybody who has a computer can spread the word, whatever that word he or she chooses to make that word. And sometimes it's
Right.
good and sometimes it's bad information. So I'm curious. You probably see a lot of data on like Fidelity customers and how they trade options. And, I'm sure some of it's top secret. But what can you tell us about what kinds of option trading strategies are most popular among your customers? Well, let's start there. And I guess after that, I'd love to hear like what mistakes do you often see?
There's many different reasons that our customers will utilize options. And as you know, it's everything from income to directional to from directional to portfolio protection. You got a large concentrated position, how can I use options to, manage the risk, or, to be able to generate, some income on that, or I think the market is going up or it's going down. So there's directional plays, and then we get into spreads. We get into uncovered options and and other reasons why. And at Fidelity, when we have a wide range of users, and they all in one form or another, some will use different strategies to accomplish those. But I think, Dan, what we see, and it makes a whole lot of sense, I think, is that most customers start out with basic types of strategies. Income, right? I mean, so I own shares. I know that if I sell this cover call, that I can bring in, $100 or $50 or $200, depending upon the number of, shares. So that's something tangible, that customers can get their head around, that if I do this, I'm obligated then to do that. And for that, I get this. And so I think those basic strategies, cover calls. I mean, as you know, I mean, we have a lot of folks who buy options, buy calls, buy puts. They're taking more of an investing strategy. where they're looking to take advantage of the market, or an underlying, security rising, in value, or, falling. I mean, we have event driven. We see a lot of cover calls, cash covered puts, long options. I mean, those strategies that are fairly simple and accomplish a specific goal, whether it's income generation or acquiring value, through the movement of the underlying security, without having to buy the security. Then you get into spreads and other things, which are a little bit more, advanced. And I think across the industry, we've seen growth in spreads trading, where customers are starting to get a better idea. And I think that goes back to the education, right? So a lot going on within the industry. We've seen tremendous growth, and I think that we only have that because, of the education, and we're seeing customers utilizing a bunch of different strategies. But I think when customers get started, they have something very much in mind that they want to do, and a lot of times that's either buying an option or generating income on something that they already own. So then you ask the $1 million question, what mistakes do our customers make? I think, part of that is, from an education standpoint, not fully understanding potentially what they are, what could impact the investment they're about to make, but more importantly, a plan. A plan not only to take profits, but also take losses. It's hard sometimes to see, the value in our position go down, because if we're long, call options, we think that it must go up, that I made the right decision, that, it's going to go back. Well, it doesn't always have to do that. Same thing if you're buying puts, it doesn't always have to fall in price at that point. So it's very important not only to, book your profits, but also to take your losses. And we need to have a plan going into it, not after the fact. You can adjust, that plan, but not having one is, I think, the biggest issue that I see with with investors in general. And that's from when you and I, were working together back at CBOE, to today. Important to have that. And I think our tools are getting better. We're helping customers, realize the importance of being able to do this, and being able to, to manage their accounts more effectively.
Yeah, that is definitely one of the things that I love to preach as well, is that plan. Oh my goodness.
It's hard for us to do it. Imagine, someone who's, new to investing, whether it's stocks or equities, and you get caught up in your own trading and what you're looking at. So, but sticking to, what you decided going into that is super important. And sometimes you're not going to make as much. Sometimes you're going to take losses and get out, when it may rally back. But, overall, a consistent approach is the right way, it is the right way to go. I was told, I mean, you're never going to sell for as much as you possibly can, and hopefully you're not taking the maximum number of loss, that you can. It's always somewhere in between, that you're going to be consistent. You're going to, start, to have a real good plan, and then hopefully, your investing grows.
Yeah, that idea of a plan, we had a mastermind recently in Chicago where we help people put together their plan. And that was one of the things that I think maybe everybody that we were working with brought up. It's just, how do I come up with a plan? Where do I start? I'm staring at a blank page, and
Right.
I don't know.
Well,
So,
and it's not only, when to get in to get out, but it's how much to put into, the investment as well, right?
yeah.
So if you have, $1,000 to invest, do you put $1,000 into one single trade? Well, probably not, because what happens if the investment, doesn't work out for you? You know, I mean, some diversification, and $1,000 can be maybe, tough to diversify significantly. But what if you have 10? What if you have 20? What if you have 30? So it's good to understand how much you're willing to commit to any one investment, but then also the plan. So it's planned from beginning to end, really. It's not just at the end.
Hmm. Yeah, I like to tell people, even a bad plan is better than no plan.
That's right. Because you can adjust the bad plan, and if you don't have a plan, then what?
Right, right. So earlier you brought up covered calls. Let's talk for a moment about covered calls,
Mhm.
which for our listeners, that is when an investor owns a stock and sells short a call on that underlying stock. And as you pointed out, these are pretty commonly traded. And it's a big part of the book that I'm writing that the show is based on. Why do you think covered calls are so popular? They're arguably not quite as easy to understand as just buying a call. Why do you think they're so popular?
So yeah, I mean, I mentioned a couple of things that I really think drive the popularity of customers using cover calls. One, they already know the stock, right? So they understand the price movement of the stock. Hopefully they do. They understand the fundamentals behind it. They have a really good idea as to where they think they go. So that's the most important thing, right? Is understanding the investment that you already have. Then it's all about, well, how do I improve the performance of this security? And you're right. I mean, it's not as easy to understand as just simply, buying a call or buying a put, right? I mean, there's a lot that goes into those two things, from volatility to price movement of the underlying stock, event driven issue or events can affect, just buying options. But with cover calls, there's an obligation. And typically, someone, may have, well, not typically, but maybe someone has held that security over a number of years and they've got a large tax, or cost basis in that. They come in, they sell cover calls. Do they understand that obligation? Do they understand, what it's going to take? Are they willing to sell the stock at that point? The most important, from the popularity standpoint, though, besides just understanding the mechanics behind the whole thing, is that again, I go back to the tangible outcome of selling a cover call, and that's seeing money come into your account, right? Customers understand that, if I sell this cover call, that I'm obligating myself to sell at a particular price that I would be willing to get out of this position. But in the short term, I'm going to earn, some dollars, whether it's $50, $100. $100 is a nice meal for two, right? For somewhere. And so I think that the popularity therein lies, and it's not passive income, but I mean, because you really have to work it, cover call right. You have to be able to understand, well, when do you roll? When do these options expire? When do these other things happen? But I think that the popularity really revolves around that premium, right? And bringing in the money. And again, it goes back to our previous discussion on having a plan. Well, what happens if the stock goes above, your obligation? What happens if it stays where it's at? And as important, what happens if the stock falls? Because you still have stock risk at that point. But it all comes down to, again, I think from a popularity standpoint, bringing in the premium, seeing something come into your account and then being able to do it over and over and over and over again. It's like a dividend, but you got to work a little bit more for this, and really be involved in the process.
Yeah, yeah, yeah. Well, I know in my Fidelity IRA, I not only trade covered calls, but cash secured puts too.
Right.
And I think there are some brokers who don't allow cash secured puts in IRAs. Some don't even allow options. Is there a certain set of criteria that traders must meet to be able to sell puts in IRAs? And why does Fidelity allow selling puts while some other firms don't?
Yeah, I mean, I think we're consistent with others, in the industry. I mean, you need to apply, to be able to trade options, regardless of whether it's an IRA or a regular, brokerage account. So if you meet that specific criteria, there are certain strategies that Fidelity and others, will allow you, to implement. Cover call writing, is one of, the more basic, because you already own the stock in the account. But with cash covered puts, it's very similar, right? So I'm setting aside, the amount of cash that I would be required, to pay if obligated to buy the stock at that strike price. So again, it's a very conservative approach to buying the stock. And why do customers do that? Well, it's for the same reason that they sell cover calls. They get a premium coming in. And so I think that, in looking at that from a strategy perspective, I'm willing to wait, in order for the stock to come back, to my price. So again, it's about understanding the underlying stock, knowing where it's going to go, being willing, to wait. And I think that, that's, one of the reasons, why, being able to set that aside, generate potentially a higher return than what you might receive. Well, in a money market fund, rates are a little bit higher today than they were in the past 10 years, where zero is anything's bigger than zero, right? It is one of the reasons, why people will look to cash cover puts. But, it's a strategy. There's also something called the wheel, right? You sell the puts if you're assigned, and you sell the calls. And people like, doing that because it's a conservative way to earn income. You still have to manage it. You still have to be, watch all those risks that are associated with the underlying stock movement. Does it go the wrong way on you? And then have that plan to get in and out and to manage those risks. But, it's definitely an approach that, investors, do like to take.
Yeah, I think a lot of investors do. And sometimes cash covered or cash cured puts, sometimes they get a bad rap. Why do you think that is?
Well, I think some of the bad rap comes from someone's bullish, on the underlying security. They sell the cash covered put because they want to generate, they want to bring in, the premium, from selling the put, but then the stock goes up, right? And while you get to, the option, the cash covered put will expire worthless, and you get to keep the premium. All the customer sees is, or the investor sees, is that the stock is up $1, $2, $3, $4, and they potentially missed out on that. Or, on the opposite side of that, the stock goes significantly down, and you're obligated, still to buy at the strike price, and your break even's the strike price less the premium brought in. So for me, and this is just in my opinion, that if the stock goes too high or goes too low, that's where, some of the bad rap for these cash cover puts, get in. But it's just like managing the underlying stock. It can either go too high, it can go too low, based upon you selling, the cover call. And so you would manage it much in the same way with the same expectations. But for some reason, yes, you don't get, the same participation on the upside, as you might with the underlying stock. You get to keep the premium, at this point. And on the downside, you have the same risk.
Now, outside of covered calls and cash cured puts, does Fidelity allow other income-based option strategies too, like credit spreads, for example, in IRAs?
Yeah, again, like, others within the industry, and, and being, like others within the industry, we do allow that. You do have to go through the application process, and if approved, you can sell credit spreads, buy debit spreads, as well. So those strategies that have a defined risk, within there. And so it is and can be a conservative approach, to either generating income or being able to participate. Because with spreads, you're setting a buy and a sell target. And so you're really putting your plan in place, at that point. It has to be managed. You have to understand, what you're doing within that. But yes, you can do that within an IRA, like, other competitors within the industry. So.
So here's something that I have wondered. Speaking of income trades, do most traders close out their covered calls or cash cured puts or credit spread positions prior to expiration, or do they hold positions and let them go all the way to zero and expire?
It depends. Next question. No. Yeah, I think that over, some data that we've seen within the industry, that the majority of customers close their positions out. That closes out either the obligation or eliminates the rights, that they have. So many customers are looking just to take advantage of either, well, are either looking to take advantage of the premium going away. For example, cover calls or cash cover puts are expiring closer to that, taking the difference between where they sold it at and buying it back in order to lock in those gains. And it's the same thing with buying options. They're looking to buy for $1, sell for $2, and so they would potentially look to close those positions out. But the majority of customers, do tend to close them out. I think the next tranche probably is those who let them expire worthless. And then there is a small percentage, not a small percentage, it's still good, but those who will either exercise their right to buy or to sell the underlying stock, and those who will take on the obligation, of either buying or selling, the stock at the strike price. But majority of customers close them out.
Hmm. Yeah, I encourage people to do that all the time. Now, a reason that I asked that question is because, correct me if I'm wrong here, if I phrase this incorrectly, but at Fidelity, I think you can close short options by buying them back if they're under $1. Is that what it is?
55 cents or less.
55 cents or less. Okay.
65.
Okay. And that's for no commission, right?
Correct.
So is that by design? And why is Fidelity willing to do that?
It is, but well, it is by design, and I think it's just another decision point, that we try to eliminate from the customer's thought process when determining whether or not to close out. If you've got one contract and it's worth 50 cents, or I could close it out for 50 cents now, but then I also have to pay 65 cents, for it. It just, it tends to be one of those things. Well, maybe I'll hold on and see if it'll expire worthless, so I don't have to, pay those additional, fees. We wanted to just, remove, that from the calculus, because I think it's important for a customer in order to manage, their positions as they approach expiration, to be able to, close it out when appropriate, for themselves, to roll to that next, position, and make sure that they have the fees, don't play, a role, within that 65 cents, or less. But it's just good for them to be able to look at the investment and what they want to do next. And then to, as you said, I mean, you encourage people to do that. When we close out that obligation, we know exactly, what our gain, what our loss was, and we don't have to worry about something happening, after the market close or after, the time that I close this out that may affect me negatively at this point. It allows me to, again, to lock in those gains and or losses, and then to be able to, look at the next investment.
Yeah, and I mean, I can totally see that from the customer standpoint, and I'm a Fidelity customer too, so I definitely appreciate it.
We appreciate that.
But I mean, I guess I can see how and why, at least the way I think about it, Fidelity does that to enable people to make those better decisions. But geez, then what does Fidelity really get out of it? Is it just that they get smarter customers who manage risk better, therefore they can be better customers, or what's the logic?
The logic is we're trying to do what's in the best interest, of the customer, helping them make good informed decisions, without having to overthink or to, bring something in to, to just remove one of those decision points that they have to make. Because position management is super important. You have to understand where you've been, in order to know where you're going. And so just making sure that you have that you can, then, move forward with that is really good. So, but I mean, just, trying to help, the investor, again, to make good informed decisions.
So, okay. You want your customers to make good decisions to
Yes.
succeed. That's in your best interest. You want them to grow and prosper. And, I want that too of my student traders that work with market taker. So, and boy, oh boy, I'm reading my notes here, and this could probably be a long answer here, but so what advice would you give to investors who want to be successful?
Well, it's probably not as long of an answer as you think it could be. I mean, we've talked a lot about what decisions need to be made, what an investor has to go through before they even trade before they even trade an option. It's utilizing the resources, educating themselves on the benefits, the risk, what how options are priced. And that's a big one. I mean, you've got a book out on it, right? I mean, options pricing, super important, because I mean, the worst thing, and it's happened to me, I was right, but I was wrong, right? So I bought an option, the stock moved in the direction, but it was worth less than when I bought it. And, it's volatility. And volatility is, it can be a tough thing to get your head around. But the more the better you understand. And you can see, some of these things in practice, just by watching, around events and things. I mean, volatility tends to grow, before the event and come out afterwards. But educating yourself is the primary and the key. Starting small, is another thing. We don't have to be 100% all the time in everything that we do. A small investment to better understand after we've educated ourselves. Selling cover calls, is a great way to start. Buying a single option, maybe the right approach for others. But starting small, is a big thing. And then having that plan, right? And so having that plan, not only of how much you're going to invest, but when to get in, what the process is for you to make a good decision, and then when to get out, both for profits and for losses, is super important. And then reevaluate, what went well, what didn't go well, because doing the same thing over and over again and getting the same results, I guess if they're good, that's fantastic, right? But we can always learn from, both, right? From both our winners and our losers, and, continually, educating to grow ourselves. So I think those are the main things. Find a good, broker. Fidelity is a great one, for your listeners to come to, and utilize those resources, better understand what's going on, attend, a few, webinars, know what's going on within the market. So you have to educate, then start small, and then you can, then utilize and implement your strategy, and then learn from it and see where things, go from there.
I really like that you touched on that reevaluate afterwards and, just learn from successes and mistakes. I think that's super important for sure. And that you pointed out too, which I love to do myself too, as well, that your plan contains criteria for taking a profit and a loss. Like,
Right.
it's such a big deal. Oh my goodness. Okay. Well, man, this was kind of fun. Let's end on something a little different here. Do you have a favorite book or movie on trading?
From a moving, from a movie side of things, Trading Places is always fun to watch. It's just, yeah, it was one of the things, that, Dan, just being able to, you were on the floor. I visited the floor a number of times, and just seeing how that marketplace worked. And you get a small taste of that, in Trading Places, albeit commodities versus options. And it was a unique and very interesting, experience. And so that was, that was, one of my favorites. There's a number of others. I mean, to walk through. But that was a good one. I always like that one. From a book standpoint, I mean, you do a really good job, with the option Greeks. I really enjoy, your book there. I mean, I think it is well thought out and gives, the investor the right approach, to looking at those. The other book too, your and my friend Larry McMillan,
Mm.
the options as a strategic investment, is one that I always love. And Dan Bittman, index options, I mean, I thought was a good read. I miss Jimmy and Larry. Haven't seen either of them in a bit of time, but definitely enjoyed and learned a lot from both of them when it came down to it.
Oh yeah. Uh, Bittman taught me how to teach options is what I like to say.
I think he's still teaching me. He said I haven't seen. I've seen him maybe. It's been a year ago, and touch base every now and then with him. But yeah,
Oh,
he definitely. I owe him a lot for sure.
oh yeah, yeah. It was demoralizing when he was teaching me how to teach options. But yeah, I'm in the same boat. All right. Well, thank you very much for spending your time and your knowledge and your experience with our listeners. I think this was really, really great. Is there anything else you'd like to leave us with? Some parting thoughts before we call it a day?
No, I mean, Dan, I want to say thanks for, having me, on the podcast. I mean, good luck with everything, the book and all that comes, with that. I've enjoyed it. I would just tell the listeners, keep learning, keep an open mind, in what you're doing, and best of luck to all.
All right. Greg Stevens, thank you very, very much for hanging out for a bit here with us.
Thanks, Dan.
All right. Until next week, trade smart.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.